The best thing about investing is there's an infinite number of ways to invest your money and grow your wealth. And if you're someone who wants to pour some gas on the fire and really accelerate your investment returns this year, this video is for you. By the end of this video, I'll give you 4 of the absolute best growth ETFs that you can use to both accelerate your gains and diversify your portfolio, including one that has beaten the S&P 500 by a whopping 150%. And the best part is, you likely haven't heard of most of these ETFs before right now. If you're new here, my name is Jay, and from here on out, I will be your personal guide to mastering your money so that you can grow your wealth and achieve your goals of financial freedom. And today that means talking about growth ETFs. Now, growth ETFs' sole purpose are to invest in companies that are likely to grow faster than the market as a whole, which make them a great addition to your investment portfolio if you don't mind taking on a little extra risk for potentially massive returns. And by investing in a growth ETF, you're still getting a diversified investment that'll manage your risk much better than if you tried to handpick individual companies on your own. Each one of the ETFs I'm going to show you today invests in different ways. So I'll give you everything you need to know about each one so you can decide which ones interest you the most and do your further research from there. Our first growth ETF today is one that gets overshadowed by more popular options like VUG, the Vanguard Growth Index Fund, or QQQ, the Invesco Nasdaq 100 Index Fund. But this ETF has outperformed both of those and most other growth ETFs over the past few years. And it outperformed the S&P 500 by nearly 62% over the last 5 years. Its ticker symbol SCHG, the Schwab US Large Cap Growth ETF. And it's returned nearly 38% over the past 1 year and nearly 146% gains over the last 5 years. The SCHG ETF invests in stocks that are included in the Dow Jones US Large Cap Stock Market Index. It's a diversified ETF as it holds 229 different stocks. And the secret to its amazing performance becomes clear once we take a closer look at SCHG's holdings. Because a whopping 47.8% of SCHG's holdings come from the technology sector, which I'm sure we're all aware of is where all of the explosive growth in the stock market has happened over the past several years. And this is reflected in SCHG's top 10 holdings, which read like a list of the best performing stocks over the past 5 to 10 years. Apple, Nvidia, Microsoft, Amazon, Meta, Tesla, they're all here. The best part about SCHG, however, is that it delivers all of those explosive gains and growth for a minuscule cost. The expense ratio on this ETF is 0.04%. That means it'll cost you $4 per year for every $1,000 you invest. That is about as low as you can find. And it's right on par with some of my favorite index funds like VOO and VTI from Vanguard. But there is some risk that comes along with investing in SCHG, and that comes in 2 forms. The first we just kind of touched on. Because SCHG is so heavily weighted towards the tech sector of the stock market, if that sector sees things slow down at all, or if another area of the stock market heats up and becomes the one that delivers a lot of growth going forward, you could find SCHG start to underperform ETFs or the S&P 500 as a whole if its holdings don't shift quite in line with that shifting performance in the stock market. Secondly, most of us have our investment portfolios built on a base layer of broad index funds like the S&P 500 Stock Market Index Fund or the total US Stock Market Index Fund. And because SCHG is a large cap growth ETF, that means by holding it in addition to an S&P 500 index fund, we're really doubling down on those large mega cap growth stocks. Look at the top holdings of SCHG once again. They're all household names. They're all the largest stocks in the stock market, which also means they're the largest holdings of our S&P 500 or total stock market index funds as well. We can see how this plays out when we compare the holdings of SCHG to VOO, the Vanguard S&P 500 Index Fund. 120 holdings overlap between these 2 ETFs. That means if you plan on holding SCHG in conjunction with an S&P 500 Index Fund, you have to be okay with doubling down on your concentration on those 120 holdings. But if you're looking for a growth ETF and you don't want to be so heavily invested in the tech sector, the next ETF on our list may be the one for you. It's returned just under 50% over the past year and 170% over the last 5 years. Once again, crushing the S&P 500 over those timeframes. And it's done it while only being 22% weighted towards the technology sector. This ETF is instead a bit more evenly distributed, with 24% of its holdings being in financial services, 22% in tech, 13% in consumer staples, and just over 10% in the industrial sector. This ETF is ticker SPMO, the Invesco S&P 500 Momentum ETF. And this ETF holds 100 stocks from the S&P 500 index that it determines have the highest momentum score. How they do this, in their own words, is by evaluating the percentage change in stock price over the last 12 months of each stock in the S&P 500 index. Then, and I quote, applying an adjustment based on the security's volatility over that period. So no exact details on that calculation, but again, in their own words, looking for stocks that, quote, exhibit persistence in its relative performance. So basically what they're doing is they came up with a calculation to find stocks that have been outperforming over the past 12 months and look to continue outperforming over the near future. And while this overall ETF isn't as heavily weighted towards the tech sector as we saw with SCHG, the top holdings do bring back some familiar names. Amazon, Nvidia, Broadcom, and Meta are the top 4 holdings of this ETF. But after that, the rest of the top 10 gets significantly less techy, with names like Berkshire Hathaway, Costco, and Walmart making an appearance. SPMO does come with a slightly higher expense ratio, coming in at 0.13%, meaning you'll pay $13 per year for every $1,000 you have invested in the SPMO ETF. That's slightly higher than most index funds you'll find out there, but it's still very low and a completely acceptable expense ratio for the performance that this ETF has shown. The risks of SPMO are, again, fund overlap, this time to an even greater degree, as 100% of the holdings of SPMO are contained in your S&P 500 index fund. Now that might be fairly obvious, as it's starting with the S&P 500 as its base of stocks it's picking from. I'm also slightly wary of relying on quote-unquote momentum. If there's anything being a sports fan has taught me, it's that momentum changes quickly. One minute your team is taking the lead and is 13 seconds away from the Super Bowl, and the next you're sitting in stunned silence on your couch feeling like you just got kicked in the gut. Anyway, my point here is that momentum can change at a moment's notice, and if their algorithm or calculation can't predict that momentum shift quickly enough or accurately enough, SPMO holders may find themselves underperforming the market they set out to beat. Before we get too much further in this list, I should note, blindly chasing performance and investing in something because it's put up big numbers over the past few years is the wrong way to invest in these or any other investments you may choose. Before you put money into anything, make sure it fits your goals for your money and your overall investing strategy. And stick with me towards the end of this video to see which ETF I am personally heavily invested in to add a boost of growth and performance to my investment portfolio. Because if you're like me, you've built the foundation of your portfolio around an S&P 500 index fund or a total stock market index fund. And those problems of fund overlap with SCHG and SPMO might make them less attractive options because of how they'd affect the balance of your overall portfolio. Our next growth ETF doesn't have any of these fund overlap issues because it's a mid-cap growth fund. Most of the holdings in our first 2 ETFs were in large or mega-cap stocks, companies with over $200 billion in market cap. Mid-cap stocks are smaller. They're sized between $6.7 billion and $18 billion in market cap size, which is how XMHQ, the Invesco Mid-Cap Quality ETF, avoids all of those overlap problems with the S&P 500 index. These stocks simply aren't large enough to qualify for the S&P 500. XMHQ chooses the stocks it holds by scoring the stocks in the S&P Mid-Cap 400 index on a quality score based on factors such as return on equity, accruals ratio, and the financial leverage ratio, and then buying the highest scoring 80 stocks after that calculation is done. Again, in simple terms, the ETF is looking for any mid-sized companies that generate higher revenue and more cash flow than their peers, while being financially prudent as a company in doing so. So the companies included in the XMHQ ETF should be the top performing mid-sized companies out there that don't mismanage their cash or take on loads of debt in order to get that performance. XMHQ is weighted 34% towards the industrials sector, and there are a few familiar names amongst its top 10 holdings, such as Williams-Sonoma, Owens Corning, and Toll Brothers Builders. XMHQ has had a bit of a rough go over the past 1 year, returning 14%, but it does outperform the S&P 500 over the last 5 years, returning over 87% in that period. The real value to XMHQ, though, is that this is the first ETF on the list that you can use to really and truly diversify your investment portfolio. Like we mentioned, not a single stock in XMHQ is held in your S&P 500 index fund. So aside from providing extra growth opportunities, XMHQ might be a good option to look at to consider diversifying your portfolio away from being so heavily weighted in those massive companies that dominate the S&P 500. XMHQ does have the highest expense ratio we've seen on this list so far, coming in at 0.25%. So you'll be paying $25 per year for every $1,000 you invest in this ETF. A bit higher than the market average of 0.12% for a passively managed ETF, but well within what I would deem acceptable when considering an ETF for my own investments. And the main risk of XMHQ is that while yes, it has outperformed the S&P 500 over the past 5 years, it is down on the S&P 500 over the past 1 year. And with so much of the stock market's overall growth being driven just by a small number of those mega huge large companies over the past couple of years, holding XMHQ risks underperforming the market until that trend shifts. And historically, there are shifts in performance between large cap, mid cap, and small cap stocks. And we don't know how, when, or why these shifts in performance will take place, which is one of the keys that diversifying is such an important part of any investment strategy. I will say, however, that small cap and mid cap stocks tend to perform better in low interest rate environments. And with the Fed continuing to cut interest rates into the foreseeable future now, I wouldn't count out XMHQ from overperforming over the next 12 months. And don't shake your head at the next ETF on this list, because it's beaten the S&P 500 by 13% over the past year, and by over 150% over the past 5 years. That's right, this ETF has beaten the S&P 500 by 150% over the last 5 years. The ETF is ticker SMH, the VanEck Semiconductor ETF. Oftentimes, finding growth that will trounce the stock market in general means you have to find a specific industry of growth and make a big bet on it. The SMH ETF does just that. It holds only 26 stocks, and as you can guess, they all come from the technology sector. However, the names aren't the same ones we've seen on other ETFs in this list. There's no Apples or Microsofts here. The SMH ETF zeroes in on the semiconductor industry, which has been absolutely red hot over the past number of years, and honestly doesn't look to be slowing down with the explosive growth we're seeing in the AI sector and language learning models. And that's why the top 10 holdings are all names you probably recognize from that sector: NVIDIA, Broadcom, Qualcomm, AMD, Intel, and so on. The expense ratio of SMH comes in at 0.35%, meaning each year you'll pay $35 for every $1,000 you have invested in the ETF, which is a long way from the 0.04% we saw with SCHG. But when you get into these very specialized ETFs, you're generally gonna find higher expense ratios on them. And honestly, it's below 0.5%. So it's nothing that I would let scare me off if I was interested in investing in this ETF. 20 of the 26 holdings in the SMH ETF do overlap with the S&P 500 index. But honestly, if you're investing in an ETF like this, you just don't need to care about that. The whole point of holding this ETF is to gain more exposure to a single industry that, by all accounts, should continue to deliver amazing growth in the foreseeable future. With that said, the risks of SMH are simple. You're investing in a single industry. If anything should happen to cause a slowdown in the semiconductor industry, say tariffs on the product or materials, supply chain interruptions, material shortages, anything like that, and you're really gonna feel volatility effects on your SMH investment. It's a high-risk, high-reward play on a single industry and should be treated as such if you're considering it for investment. Now, the one ETF I haven't talked about so far is the one that I'm personally investing in as a way to boost my overall investment returns. It's an investment that has beaten the S&P 500 not over 1 year, but over every 20 and 30-year period in history. And it avoids nearly all overlap issues we've seen in many of the ETFs we've looked at in this video. And I show you exactly what that ETF is and why I decided to make it a key portion of my investment holdings in this video right here. So thanks for watching this video. I really hope you found it interesting, and I hope to see you in the next one.